When I first started learning about trading, I was trading smart money concepts like everybody else, thinking I cracked the code to how the market moves. But the deeper I went, the more I realized that the very people that were teaching those concepts were the very liquidity that the institutions were targeting. I was following the same patterns, the same entries, and I was getting played over and over again, just like thousands of other traders out there. Then everything changed. Once I understood how institutional liquidity actually works and how the market is engineered to manipulate the smart money traders, my whole view of the market flipped on its head. In this video, I'm going to show you exactly how to use institutional liquidity to trade against smart money traders, the methods that I've learned the hard way over the last 10 years, and the hidden manipulation patterns that most traders will never see. Make sure you stick around right to the end, because that's where I'll break down one of the biggest traps institutions set every single day, and how you can flip the script and start using the same liquidity for your own trades. Let's get into it.
The first thing we're going to have a look at is the daily time frame. The daily time frame gives us a clear understanding of where the market is going to head. 60 to 65% of the time, the previous day's candle will determine what the next day's candle is. That's why you get big runs in price like this, where you have bearish candle, bearish candle, bearish candle, bearish candle. So all I want you to do is to have a look at the price and just see what the previous day was doing. If the previous day was bearish, then the likelihood is the next day is going to be bearish. From there, you're going to drop down to your 4-hour time frame, and then you're going to determine where the current range is. So very simply, you're going to take the high to the low, draw out that range, and that's going to give you your trading range. This is the range that you're going to be looking for entries within. Okay. Now, the 4-hour momentum is a really powerful momentum. It ties up really nicely with the daily time frame. If your previous day is bearish, the likelihood is that you're going to be in a bearish 4-hour range as well. But the key to this is making sure that these two at least line up. If you have your daily lined up with your 4-hour, half the battle is already won. From here, I want you to have a look at the 15-minute time frame.
Why do you think everyone's trading ICT and SMC and nobody's making any money? Now, I found through years of testing these systems that there are massive flaws. I've reverse engineered the holes in these systems to make a highly profitable, repeated strategy, but with a much better win rate and without huge periods of drawdown. Now, I don't know about you, but I certainly couldn't handle an 18, 20% drawdown. The best gift I can give you is the ability to win regularly. And every single student that I work with not only gets a money back guarantee, but also gets given that gift of being able to win regularly with at least a 50% win rate. My name's Chris. I've been trading for 10 years now, and I built SMF Trading to help a small group of people become profitable traders. This is a closed door community, meaning if you're seeing this advert, we have spaces available. I can only take on so many people because I work with everyone on a one-on-one basis. Because I make my money trading, I don't need hundreds of members, and that's why we keep a strict closed door policy on how many members we take on. This is a small exclusive community where you will be taught how to become a professional trader. Hit that link below and let's get to work.
And on the 15-minute time frame, you're just going to draw out any significant highs that you can see. Just draw lines above them like this and then drag them out to the left. Okay, these are your liquidity points. Now, a lot of people focus too much on liquidity points and they're like, oh, which liquidity point do I need to trade off? It doesn't fucking matter, okay? People are too precious about liquidity points themselves. It doesn't matter which liquidity point your trade reacts from. What fucking matters is the reaction. Okay, little rhyme for you. Doesn't matter which liquidity point it reacts from. What matters is the reaction. Like it? This is our section of price. We're going to draw out all the significant liquidity points that we can see, and then we're just going to wait for a reaction from one of them. So let's play out price. Okay, so we've had a reaction from this. Now, the reaction itself is really, really important. This is where I drop down to my 5-minute time frame. I want to see price clearly moving away from this liquidity point. If price is clearly moving away from this liquidity point, it's going to change structure on the 5-minute time frame. It's going to give us a clear change in structure. Now, again, another thing that so many traders get wrong. This is not a clear change in structure. This is what we call in the industry a false breaker structure. And what's more likely to happen in this scenario is price is more likely to be buying back up. Okay, now that in itself is an entry, okay, but that's for another video altogether. We have to wait for the second breaker structure to confirm the move. That is now a confirmed bearish shift. You SMC traders think one change of character or one break of structure is enough to get you into a trade. It is not. Okay, trust me, I've learned the hard way. I was an SMC trader for 2 years and I was incredibly unprofitable. Let's just put it that way. The reason why there's 1,000,001 SMC courses is because they don't work. Good educational liquidity is hard to come by. Think about that. Why? Because people don't want to sell it because it fucking works. So we're waiting for a shift. Okay, let's have a quick look. So we've had first break of structure here. Let's mark that on as our first break of structure. And then we've had our second, or what we call our true break of structure. Now we just need a manipulation. We need an internal manipulation. So the same thing again, guys. We're looking for an internal manipulation. Let's mark these on as red. We're looking for an internal manipulation. And if we can get an internal manipulation, we can then look for a trade. Okay, perfect. So look at how many steps we've gone to confirm this entry. We've had daily, 4 hour, 15 minute, 5 minute shift. Now we're going to jump down to an even lower time frame. So we need a shift on this time frame now. Okay, remember the first break is not enough. The first break is not enough. We need the second break, because what normally happens is, as we can see, prices created the trap. That first break of structure, we normally have a trap. Okay, let's have a quick look now. Let's see if we can get a confirmed entry. So we've got a confirmed entry here now. All we're waiting for is for price to give us. So prices pulled back bullish. This is our true break of structure. Okay, we confirmed that we've got a true break of structure, but prices pulled back bullish. So many people now would be entering here, okay, and then getting stopped out, of course. If price pulls back bullish, we need to wait for it to correct. Okay, now we've corrected. Okay, we can get into this trade like this, stop above the high. First profit target will be down there. Let's see if we get it, and then boom. Okay, news helps us out nicely to get into there. So these are the exact 5 steps that I take every single time that I trade. You can see that it is a highly profitable setup because there's so many moving parts. That is an entire liquidity strategy in just 5 minutes. If you learned something today, do me a massive favor, hit that like button, subscribe to the channel, and I'll catch you in the next video. Cheers.